I also want to talk a little about the categories of mutual funds. You use the word ultra short term. Some people say liquid funds. Some people say diversified equity funds, mid cap funds. If you can explain that a bit, because for someone who's just beginning and who hasn't wet her feet, can you really rise above this confusion and explain that?
See, try to make it very simple. Broadly, there are two types of asset classes you have. One is debt, second is equity. Now, within debt, you can further categorize that into various categories. Just again to keep it very, very basic, debt will have either an ultra short term, which is also being called as ultra short term funds or liquid funds. As the name says, this is to be invested for a short duration of time. You can even invest for as less as 7 days to 15 days. But if your horizon becomes 3 months, then you go to the next category, which is short term. So short term could be anything from a 3 months to a 1 year period. Once you cross that level, you go to a medium term. So 1 to 3 years becomes medium term. Cross that level also, you go to a long term. Anything beyond 3 years, you become long term bond. But also understand, the returns will keep on increasing, albeit on a very slow basis, because debt cannot offer you beyond a point. But the risk level also increases. Yes, you heard it right, risk. Debt also carries a risk. There is a mark-to-market risk, there is a credit risk, there is an interest rate risk. It is not a fixed income asset class. It's not like your bank FD or a PPF or any other instrument which gives you a assured income of 7%. And that's the reason, because you're getting it in higher than a fixed income asset class, the return becomes a little bit on the risk rate. Higher and long you go on a debt scale, the riskier the asset becomes. But because the level of returns also don't go up so much, the risk level is also very subdued and very low. But there is a risk. So understand that, read a little bit more about it. But these are the 4 broad categories you have in the debt space. Moving to the equity, you have various categories again. So starting with large cap, they invest in a large cap stock. You have a mid cap, which they will invest only in mid cap stocks. Small cap, the stock which are even higher risk carrying more than the mid cap strategy becomes a small cap stock. The return also varies. Mid cap can give you higher than a large cap, small cap can give you higher than a mid cap, but the risk level also goes in tandem. So risk and reward are part of the same coin. So understand that before you really go. You even have one more combination which is called as a multi-cap, which means a combination of large cap, mid cap, small cap becomes a multi-cap strategy, which is also called as diversified funds. Now these two are the broad asset classes, debt and equity. Now you can create combinations and structures between the two. For example, hybrid, which is called as balance funds popularly, is a combination of this debt and this equity. Current income tax act says if you hold more than 65% in equity, it becomes a balance fund and also carries a tax-free status if you hold for more than 1 year from the date of purchase. Now, equity becomes 65, debt becomes 35, that's one strategy. You have multiple more strategies, for example, like an MIP, which is anything from a 10% to 30% equity, 70% debt. You have a new category coming into play over the last couple of years, which is actually called as equity savings, which carries a 40% of equity, 30% of debt and 30% of arbitrage. Now, arbitrage is a play of debt, which simply means that they will buy and sell equities simultaneously, thereby making a tax product, which means it's taxable like an equity asset class, but gives you a return of debt. So we'll talk about that some other day, but broadly, there are many structures available which carries you combinations of debt and equity, but if you understand debt and equity, I think you understand it a little better.